Your government didn't announce it. The Federal Reserve didn't hold a press conference. Markets didn't crash. There were no red screens, no emergency meetings broadcast on cable news. And yet, in less than 18 months, over $5 trillion quietly moved in a way that only happens when something fundamental has broken. This wasn't a trade. It wasn't stimulus. It wasn't a panic. It was a signal. And the reason most people missed it is the same reason markets didn't want you looking too closely at it. Because when money moves this size, this quietly and this consistently, it's never random, it's defensive, it's institutional, and it's telling you something about risk that headlines won't. Let me start with a number that should stop you cold. $5 trillion. That's roughly how much has shifted into short-duration government instruments, overnight facilities, and defensive balance sheet positions since the last tightening cycle began. Not all at once, not dramatically, but steadily, methodically. The kind of movement that doesn't belong to retail investors chasing returns. This is capital that doesn't chase, it hides. And here's the part most people don't understand. This kind of movement doesn't happen because investors expect growth. It happens because they don't trust duration anymore. They don't trust promises that stretch 5, 10, or 30 years into the future. They don't trust the stability of the system that's supposed to honor them. That's the signal. To understand why it matters, you have to understand how markets normally behave when they are confident. In a healthy system, capital takes risk. It locks itself up. It buys long-dated bonds. It finances expansion. It assumes that inflation, policy, and institutions will remain predictable enough over time to make those commitments safe. Long duration is a vote of confidence in the future. What we've seen instead is the opposite. Capital fleeing duration, preferring liquidity, accepting lower returns in exchange for immediacy and optionality, parking trillions in instruments designed not to grow, but to survive. This is not bullish behavior, and it's not neutral. It's defensive positioning on a scale that only appears late in cycles, when institutions quietly conclude that the range of possible outcomes has widened too far to ignore. Now here's where this gets uncomfortable. The same system that needs long-term capital to function is increasingly unable to attract it without offering higher and higher compensation. Governments need buyers for long-dated debt. Corporations need financing that extends beyond next quarter. Pension systems depend on predictable yields decades into the future. But confidence is eroding. When trillions of dollars refuse to commit long-term, the cost of capital rises. Not because markets are panicking, but because they're demanding protection. And protection has a price. This is why yields rise even when growth slows. This is why policy tools lose effectiveness. This is why central banks find themselves trapped between inflation they can't fully control and debt dynamics they can't escape. The $5 trillion shift isn't the cause of the problem. It's the symptom. A symptom of a system where trust is no longer assumed, only rented. You've seen versions of this before, even if you didn't recognize them at the time. In the late stages of previous monetary regimes, capital stopped behaving optimistically and started behaving cautiously. It shortened timelines. It demanded flexibility. It prioritized claims that could be exited quickly over promises that required faith. This isn't about fear, it's about math. When debt levels rise faster than productive capacity, duration becomes risk. When interest expense consumes a growing share of fiscal space, long-term guarantees become political decisions instead of financial ones. And when policy responses rely on continual refinancing, the future becomes a variable instead of a baseline. Markets understand this long before politicians do. That's why the shift happened quietly. No one wanted to call attention to it, because calling attention to it would force uncomfortable questions. Questions about sustainability. Questions about who ultimately bears the cost when confidence erodes. Questions about what happens if short-term safety becomes the dominant strategy. Here's the critical point. This $5 trillion didn't leave the system. It stayed inside it. But it moved from risk-taking roles to protective ones. From funding growth to insulating balance sheets. From betting on expansion to waiting for clarity. And waiting, at this scale, changes everything. Because when capital waits, investment slows. When investment slows, productivity stagnates. When productivity stagnates, the system leans even harder on financial engineering to maintain appearances. That's how fragility builds without headlines. This is why markets didn't want you to notice the signal. Not because it was hidden, but because it was inconvenient. It contradicts the story of resilience. It contradicts the narrative that everything is under control. The truth is more precise. The system is still functioning. Transactions are clearing. Payments are settling. Assets are trading. But beneath that surface, behavior has changed. Behavior is the earliest indicator of structural stress. In the next section, I'm going to show you where this $5 trillion came from, why it moved when it did, and how the same pattern has appeared before major transitions in financial history. Because once you see the pattern, you'll understand why this wasn't a fluke, it was a warning. And the system heard it, even if it didn't say it out loud. To understand why this movement happened when it did, you have to look at where the $5 trillion actually came from. This wasn't retail money. It wasn't households reallocating portfolios. It wasn't a sudden surge of savings. The bulk of it came from institutions that operate on one overriding principle: preserve optionality when future conditions become unreliable. Banks, money market funds, sovereign entities, corporate treasuries, pension intermediaries. These are not actors that react to headlines. They react to balance sheet math. And the math changed. For more than a decade, duration was rewarded. Rates were low, inflation was contained, and central banks backstopped volatility. Locking money up for longer periods wasn't just safe, it was encouraged. The entire system trained capital to believe that time itself carried little risk. That belief broke. When inflation reappeared, it didn't just raise prices. It reintroduced uncertainty about the value of future cash flows. Suddenly, money promised 10 years from now depended on assumptions that could no longer be taken for granted. Assumptions about political discipline, about fiscal coordination, about the willingness and ability of central banks to control outcomes. That's when duration stopped being neutral. You can see this clearly in how institutions responded. Instead of exiting markets, they shortened exposure. Instead of selling everything, they moved into instruments that reset constantly. Overnight facilities, short-term bills, highly liquid claims that don't require belief in stability beyond the next decision window. This is crucial. They weren't predicting collapse, they were pricing volatility in time. In other words, they weren't saying the system would fail tomorrow. They were saying they no longer trusted the system to look the same far enough into the future to justify long commitments. This is exactly how confidence erodes in mature systems. Not through panic, but through preference changes. Now look at the timing. The shift accelerated precisely as refinancing needs exploded. Governments around the world entered a phase where massive portions of their debt rolled over within short windows. That means higher sensitivity to rates, higher exposure to market mood, and higher dependence on continual access to willing buyers. At the same time, central banks were trying to tighten policy without destabilizing the very markets that fund public deficits. This creates a contradiction that can't be resolved cleanly. Raise rates too much, and debt service becomes politically unmanageable. Hold rates too low, and inflation expectations unanchor. Markets don't debate this contradiction. They price it. And when they do, the first thing they reprice is time. Long-term promises become riskier. Short-term claims become premium assets. That's why the $5 trillion didn't chase yield. It accepted lower returns, because in an environment where uncertainty about policy, inflation, and growth is elevated, liquidity is yield. Now here's where historical context matters. This behavior isn't new. It appears repeatedly at the same stage in financial cycles, not at the beginning and not at the end, but in the uncomfortable middle phase where institutions realize that previous assumptions no longer hold, yet the system is still operating. In past transitions, capital shortened its horizon before structural changes became obvious, before currencies were restructured, before regimes formally shifted, before the public narrative caught up. This is the quiet phase. During this phase, nothing looks broken on the surface. Markets rally and sell off. Economic data sends mixed signals. Officials reassure. But underneath, capital behavior becomes conservative in ways that are mathematically revealing. Short-term instruments swell. Long-term issuance requires higher premiums. Volatility compresses in some areas and explodes in others. Correlations behave strangely. All of that is happening now. And the $5 trillion movement is the cleanest expression of it. It tells you that institutions no longer see the future as a smooth extension of the present. They see branching paths, policy risk, inflation risk, social risk, geopolitical risk. None of these individually need to trigger crisis, but together they widen the range of outcomes. When outcome ranges widen, rational capital reduces exposure to irreversibility. Long duration is irreversible. Once you lock in, you're hostage to conditions you can't control. Short duration is adaptive. It lets you respond. That's the logic driving this shift. Now consider the implications. A system built on long-term promises cannot function indefinitely if capital refuses to make them without escalating compensation. Governments can roll debt, but at rising cost. Corporations can borrow, but margins compress. Infrastructure gets delayed. Productivity investments are postponed. This doesn't cause immediate collapse. It causes slow erosion. And erosion is far more dangerous because it's politically invisible until it's advanced. The uncomfortable truth is that modern financial systems rely on confidence not just in repayment, but in continuity. Continuity of rules, continuity of incentives, continuity of institutional behavior. When that continuity becomes questionable, even if nothing has formally changed, capital adapts. That adaptation is the signal. The $5 trillion didn't move because someone pushed a button. It moved because thousands of independent risk managers across institutions that never coordinate reached the same conclusion. The future has become harder to price. In the next section, I'm going to walk you through the specific structural pressures that made this conclusion unavoidable, and why attempts to reverse this behavior through policy tools tend to fail at this stage. Because once capital relearns to fear time, it rarely unlearns it quickly. To see why this behavior became unavoidable, you have to look at the structural pressures that converged at the same time. None of these pressures are new on their own. What's new is that they began reinforcing each other. Start with debt. Modern governments do not operate like households. They roll obligations forward. Debt isn't paid down, it's refinanced. As long as growth, inflation, and interest rates stay within predictable ranges, this works. The problem begins when the scale grows so large that small changes in rates have outsized effects. At current levels, a 1 percentage point increase in average funding costs translates into hundreds of billions in additional annual interest expense. Not in theory, in cash, every year, indefinitely. That reality changes behavior. It means policymakers become extremely sensitive to market reactions. It means central banks lose freedom. It means fiscal and monetary policy begin to blur, even if officials deny it. Markets see this clearly. They understand that when servicing the past competes with funding the present, future promises become political questions. And political questions do not price cleanly. Now add demographics. Aging populations in developed economies means slower labor force growth and rising entitlement costs at the same time. Fewer workers supporting more dependents, lower natural growth rates, higher baseline spending. This doesn't cause crisis overnight. It reduces margin. And when margin disappears, shocks matter more. Then add geopolitics. Supply chains that were once optimized purely for efficiency are now being redesigned for resilience. That means redundancy. Redundancy means higher costs. Higher costs feed into inflation pressures that are structural, not cyclical. On top of that, global fragmentation makes coordination harder. Policy responses that once diffused risk now amplify it across borders. Again, markets don't panic at this. They adapt. Finally, add financialization. For decades, growth has been supplemented by leverage and asset inflation. This created the appearance of stability while embedding fragility. Asset prices rose faster than incomes. Balance sheets expanded faster than productive capacity. That model depends on low volatility and cheap refinancing. When volatility returns and refinancing costs rise, the math tightens. All of this funnels into the same pressure point, time. Long-term assumptions become fragile when too many variables are unstable at once. Debt dynamics, demographics, geopolitics, and financial leverage don't need to break the system individually. Together, they widen uncertainty beyond what duration can comfortably absorb. This is why policy responses start to fail at this stage. Raising rates attacks inflation but worsens debt stress. Cutting rates eases debt stress but risks unanchoring prices. Fiscal expansion supports growth but increases borrowing needs. Fiscal restraint stabilizes balance sheets but risks contraction. Every lever solves one problem by intensifying another. Markets recognize this asymmetry. That's why the $5 trillion didn't wait for an announcement. It moved as these constraints became visible. And here's the critical insight. Once capital adjusts to a shorter horizon, policy loses its ability to guide behavior with forward promises. Signals meant to influence expectations lose power when expectations themselves become conditional. This is when the system enters a reflexive phase. Higher yields demand higher compensation. Higher compensation worsens fiscal math. Worsened fiscal math increases uncertainty. Increased uncertainty shortens horizons further. None of this requires panic. It only requires rational actors responding to incentives. That's what makes this phase so difficult to reverse. Officials can announce frameworks. They can project confidence. They can publish forecasts extending decades into the future. But when capital no longer believes in continuity, those projections stop functioning as anchors. They become aspirations. Look at how markets treat long-term guidance now. It's discounted quickly, repriced often, conditional on data that itself is volatile. Contrast that with how markets treat short-term liquidity facilities. Those swell immediately when stress appears, not because investors expect disaster, but because they value control. Control over timing, control over exit. This preference shift is subtle, but it's powerful. It explains why massive liquidity can coexist with rising instability, why asset prices can remain elevated while confidence erodes underneath, why everything feels fine until suddenly it isn't. This is the stage where narratives become dangerous, because narratives focus on outcomes while markets are reacting to constraints. The story that everything is resilient misses the point. Resilience requires slack, and slack has been consumed. The $5 trillion movement is proof of that consumption. It's capital acknowledging that the system has less room to absorb surprises, less tolerance for error, less flexibility than it once did. And when flexibility disappears, timing becomes everything. In the next section, I'm going to show you how this loss of flexibility changes market behavior in ways most people misinterpret, and why what looks like stability can actually be a sign that pressure is being stored, not released. Because the most dangerous moments in financial history were rarely the loudest ones. At this point in the cycle, the most common mistake is to look for obvious stress. People expect cracks. They expect volatility spikes, disorderly sell-offs, visible breakdowns. When those don't appear, they assume the system is holding. But that assumption misunderstands how modern systems fail. They don't fail loudly at first. They fail by absorbing pressure. When flexibility is gone, instability doesn't express itself immediately. It gets stored. It moves into balance sheets, policy compromises, and timing mismatches. The surface stays calm precisely because the system is working harder underneath. That's what the $5 trillion is doing. It's not escaping the system. It's compressing inside it. Look at how markets behave during this phase. Volatility becomes episodic instead of continuous. Long stretches of calm are interrupted by sudden repricing events that feel disconnected from fundamentals. Correlations shift unexpectedly. Assets that should hedge each other move together. Liquidity evaporates briefly, then returns. This confuses observers. They see stability punctuated by shocks and assume the shocks are anomalies. In reality, the calm is the anomaly. It exists because capital is avoiding irreversible exposure. Short duration positioning creates the illusion of control. Everything can be rolled. Everything can be adjusted until it can't. This is where timing risk replaces price risk. In earlier stages, investors worry about valuation. In this stage, they worry about access. Can they refinance? Can they exit? Can they adjust before conditions change? That's why liquidity is hoarded. Now consider how this interacts with policy responses. When stress appears, authorities inject liquidity. That calms markets temporarily. But because capital has already shortened its horizon, the liquidity doesn't translate into long-term investment. It pools in short-term instruments. The pressure doesn't dissipate. It redistributes. This is why interventions feel less effective over time. Each one works, but for less duration. Each one stabilizes the moment, but increases dependence on the next. Markets internalize this. They stop asking whether support will arrive. They ask how long it will last. That shift is subtle but decisive. Once capital expects interventions to be temporary bridges rather than permanent solutions, it refuses to commit beyond the bridge. This is how a system becomes permanently provisional. Everything is conditional. Everything is rolled forward. Nothing is resolved. The $5 trillion signal reflects that condition. It's capital saying, in aggregate, that it no longer trusts finality, only continuity for now. And continuity for now depends on constant management. That has consequences. When a system requires continuous management to function smoothly, its tolerance for surprise collapses. Small shocks matter more. Policy mistakes compound faster. External disruptions transmit instantly. This is why periods that feel calm can be more fragile than periods that feel volatile. Volatility releases pressure. Suppressed volatility stores it. Now add one more layer. As more capital crowds into short-term instruments, the system becomes more synchronized. Everyone is positioned for flexibility at the same time. Everyone is watching the same signals. Everyone plans to move quickly if conditions change. That creates reflexivity. The very strategy that protects individual actors increases systemic risk. If everyone plans to adjust at once, adjustment itself becomes the shock. This doesn't mean collapse is imminent. It means the margin for error is thin. And thin margins change behavior. Institutions become cautious, not just about risk, but about signaling risk. Nobody wants to be first. Nobody wants to trigger reactions. So stress is managed quietly, internally, until it can't be. That's why the $5 trillion moved without fanfare. Not because it was insignificant, because it was sensitive. Attention would have forced explanations. Explanations would have raised questions. Questions would have widened uncertainty. So the system did what it always does at this stage. It kept functioning. But functioning is not the same as healing. What's happening now is not resolution. It's postponement. Postponement funded by liquidity, coordination, and hope that conditions stabilize before choices become unavoidable. Sometimes that works. Sometimes growth accelerates, inflation fades, and margins return. But when it doesn't, the adjustment is sharper because it was delayed. This is the uncomfortable truth markets understand but rarely say out loud. Stability achieved through compression is not stability, it's tension. And tension always looks calm until release. In the next section, I'm going to show you why the release point is so difficult to predict, why it rarely comes from where people expect, and why the final adjustment often surprises even the institutions that sense the danger early. Because signals like this are not alarms, they're acknowledgments, and acknowledgments change behavior long before outcomes change. The reason this signal matters is not because it predicts a specific event. It doesn't tell you the date of a crash. It doesn't forecast a recession on a calendar. It doesn't announce a collapse. That's not how systems like this end. What it tells you is that the internal logic of the system has changed. When $5 trillion collectively chooses immediacy over commitment, liquidity over yield, flexibility over faith, it is making a statement about the future that no press release ever will. It is saying that continuity can no longer be assumed. And once that assumption is gone, everything else adjusts around it. This is the final stage people misunderstand. They wait for a dramatic break, but what actually happens is quieter and more consequential. Behavior changes first, incentives shift next, outcomes follow last. By the time outcomes are obvious, the choices have already been made. The $5 trillion didn't move because of fear. It moved because the system reached a point where trusting long-term promises required believing too many variables would cooperate at once. That's not pessimism. That's probability. In every major financial transition, there's a moment when capital stops asking how much it can earn and starts asking how quickly it can adapt. That moment does not come with sirens. It comes with spreadsheets. We are in that moment now. You can see it in how governments finance themselves. Shorter maturities, higher rollover frequency, greater sensitivity to market conditions. You can see it in how corporations behave, buybacks favored over long-term investment, cash buffers prioritized, expansion delayed unless conditions are unusually favorable. You can see it in how policy is conducted, more tools, more interventions, less conviction that any one of them is permanent. And you can see it most clearly in where capital chooses to wait. This doesn't mean the system stops functioning tomorrow. Systems like this can operate for years in this configuration, but they do so with a critical difference. They lose slack. When slack is gone, errors compound faster. Shocks propagate wider. Timing matters more than fundamentals. This is why the end of an era rarely looks like an ending at the start. It looks like management, like coordination, like reassurance, until it doesn't. History is not a sequence of collapses. It's a sequence of adaptations that eventually exhaust themselves. In past transitions, the decisive shift happened when enough participants stopped believing that the future would resemble the recent past, not catastrophically, gradually, rationally. That belief is what long-term capital represents. When it withdraws, the system can still move forward, but only by leaning harder on leverage, policy support, and confidence management. Those tools buy time. They do not restore margin. And margin is what allows systems to absorb mistakes without consequence. The $5 trillion signal is capital acknowledging that margin has thinned. Not vanished, thinned. That distinction matters because it explains why everything still works and why it feels increasingly fragile at the same time. Nothing here requires panic. Panic is not how this ends. What's required is clarity. Clarity about incentives, about constraints, about the difference between stability and postponement. Markets didn't want you to notice this signal because noticing it forces an uncomfortable realization. The system is no longer operating on trust in long-term certainty. It is operating on short-term coordination that can persist, but it changes the nature of risk. Risk stops being about valuation and starts being about timing, about access, about adaptability. Those who understand this don't rush for exits. They don't make dramatic bets. They don't announce conclusions. They position themselves to respond. That is what the $5 trillion did. It didn't predict the end. It prepared for a future where the range of outcomes is wider than before. That's the real signal. Not collapse, not rescue, but transition. And transitions don't announce themselves. They reveal themselves through behavior long before headlines catch up.